All right. Okay. So I want us to look at this simple topic, flexible budgeting. Flexible budgeting. Flexible budgeting. All right. So when we talk about flexible budgeting, what are we talking about? So flexible budgeting is where we want to budget or we want to prepare our budget with an initial intention that anytime the activity level changes, we are also going to revise the budget to reflect the current or the actual activity level. So look at this. We are preparing a budget. So budgeted P&L. And then we have sales. We have cost of sales. Then we have what? Gross profit. So assuming our sales is based on 1,000 units at maybe 7 cities. So that will give us sales of what? 7,000. So cost of sales will be 1,000 units at maybe at 5 cities. So that gives us what? 5,000. This gives us a budgeted gross profit of what? 2,000 Ghana cedis. So this is our budget. Now, if we prepare a budget like this, and we have an intention that anytime the activity level reduces or increases, we are going to change this entire budget to reflect the activity level. Then we see this budget is a flexible budget. So for instance, assuming we find out that we cannot produce and sell 1,000 units, so we now want to maybe produce and sell 700 units. So our budget will change to be like this. So sales, cost of, so cost of sales. And then what? Gross profit. So sales will now be what? 5,000. Assuming 700 units, we were able to sell 700 units. So so the budget will now go 700 at what? At 7 cities. Then 700 at what? 5 cities. 7,749. So 4,900. 7,535. So that gives us a profit of 1,400. You see? So when we budget like this, then we call that entire process flexible budgeting. So we have an initial original budget. That is a flexible budget. It is flexible because we can always revise it, or we will always revise it when the activity level changes. And so activity level has changed from the initial plan of producing and selling 1,000. We are now saying that we will produce and sell 700. And so we have to we have to flex the budget to reflect the actual activity level. And so when the budget is flexed, we now have a new sales, new budgeted cost of sales, and new budgeted profit. So this is the thinking behind flexible budgeting. Now we want to do this in order to bring about fair comparison. You know, anytime we have our budget, we will have to compare with actual to identify variances and work on the variances. So assuming as an organization, we plan to produce and sell 1 million units, and maybe there was a machine breakdown. So we were able to produce and sell maybe 200,000 units. Look at the gap, 1,200,000. So if we begin to compare the sales figures based on 1 million units to the actual sales figures based on 200,000 units, we will be blaming ourselves for saying that probably we haven't done well and all that. But it's because of the activity level. If we had flexed the budget to change the budgeted figures to reflect 200,000 units, we will see that probably we will see that we would have rather been doing well instead of the bad picture that it is painting. And so that is the idea under flexible budgeting. So if you want to flex the budget, it's as simple as that. Always look for the new activity level based on which you want to flex the budget and multiply that with the selling price per unit or cost per unit. You see, so you see, we use the current activity level to multiply the original, the original selling price was 7. So the same we are using here. The original cost of sales per unit was 5. The only thing we are changing is what? The new activity level. And for fixed costs, they will remain the same. All right. So now let's pick this example. This is a past question where we were asked to flex this budget. So let's read this question. Nam and Co has prepared its fixed budget for the first quarter of the financial year. The following is the summary for the income statement. Revenue, sales revenue, 200,000. Cost of sales, direct material, 75,000. Direct labor, 50,000. Variable overheads, 25,000. Semi-variable overheads, 35,000. The fixed cost in the semi-variable cost is 10,000, and the budgeted units were 10,000, but actual units for the quarter were 17,000. All right, so prepare a flexed budget for the first quarter. Okay, let me add that. You see, we have a flexible budget. And then a flexed budget. And then a fixed budget. So the flexible budget is the original budget, which we have intention of revising anytime activity level changes. That makes it flexible. So that such a budget is flexible budget. Now, the flex budget is when you have a new activity level and you flex the budget to reflect that new activity level. So the new budget you get is known as a flexed budget. So if you want to rhyme, we will say a flex budget is a flexible budget that has been flexed. You see, so if you have a flexible budget and you revise it based on a new activity level, we will now have what? A flexed budget. And a fixed budget is a budget which so that is the opposite of a flexible budget. A budget we prepare with no intention of revising, no matter the change in activity level, is known as a fixed budget. But a budget with intention of changing to reflect new activity level is known as flexible budget. So those are some terms I want you to take notes. So see what we are required to do. Prepare a flexed budget. So it means that this original budget is a flexible budget. So they want us to now revise the budget based on the new activity level. So the budgeted units, so they budgeted with 10,000 units, but they've realized that they can now do 17,000 units. So the original activity level is 10,000. They want us to flex the budget to reflect 17,000 units. And so exactly that's what we want to do. All right, so let's start. So we start flexed budget. All right. So we start with what? With sales. So we know that we are keeping the original selling price, and then for the variable cost, we are keeping the per unit. So looking at this one, the sales, what is the original selling price? So the original selling price will be the 200,000 divide by the original output activity level was what? 10,000. So divide by 10,000. That gives us what? 20. See, so we are multiplying 20 cedis. Let me add the CD sign. So we are multiplying 20 cedis by the new activity level, which is what? 17,000. You see that? Then we now come to cost of sales. So cost of sales, we have DMAT. So DMAT, that is a variable cost, direct material. So it's a variable cost. So the same thing, we divide 75,000 by what? The original activity level of 10,000. We get 7.5. So 7.5 multiplied by current activity level of what? 17,000. We now have what? D lab. So that will be what? 5 cedis. If you divide, you get 5 cedis multiplied by what? 17,000. And then we have variable overheads. So that one too, we get what? 2.5 multiplied by what? 17,000. See that? And then we've been told that the semi-variable overheads, the fixed cost in the semi-variable is what? 10,000. So fixed is 10,000, meaning the variable is what? Is 15,000, because the total amount is 35. And we know the fixed plus the variable will give the total. So if fixed is 10,000, meaning the variable is what? 25,000. So semi, the variable among it is 25. So if you divide the 25 by 10,000, that will give you what? 2.5 multiplied by what? 17,000. See, so we just multiply. So let's multiply. 7.5 times 17,000, 127,500. 127,500. 5 times 17,000. 85,000. 85,000. Divide by 2, 42,500. So 42,500. 42,500. Then 20 multiplied by 17,000. 340. So we have what? 340. So 127,500 plus 85,000, 42,500, 42,500. 297. All right, so we need to add the fixed. So the fixed among it is 10,000. As for fixed costs, it doesn't change anytime we are flexing a budget. So it will still remain the same. So plus 10,000, 307,000. So the total will be what? 307,000. Now we deduct that and we are going to, all right, so let's deduct that minus 340. So 32,500. So we have 32,500. You see that? So that is that for the flexible budget or the flexed budget. As simple as that. As simple as that. So just look for the fixed cost. As for the fixed cost, it won't change to remain the same. The sales, look for the original selling price and multiply it with the new activity level. The variable cost to look for the variable cost per unit and multiply with the new activity level. That's all. All right, there's another question. So this is also another question. All right, let me pause here so that I can also, give that in a new, um, in a new video. All right, thank you. Bye bye.